have we gone through a correction, or are we in the early stages of a new bear market? What we talk about and what we have our data on is supply and demand, and measuring accurately the forces of supply and demand, the balance of supply and demand, that trend. What were the conditions on September 20th? Demand was in a downtrend, and our buying power index was basically telling us that there was a great deal of selectivity in the market. We had a real parabolic move in selling. It really went up quickly and powerfully. In fact, in the last 3 days of that fall, you had what we call 80% downside days. And what does that mean? That means that 80% of the volume and 80% of the points in the NYSE index were to the downside. In fact, the last day was an 89% downside day, and we've done a lot of work on this extensively through history with 90% downside days, that they are key to getting that exhaustion, at least on the sell side, but it's not complete without a reversal to the upside. On the 26th of December, that's exactly what we got. We got a 90% upside day. Since then, on the 4th of January, we had another 90% upside day, which included 90% advancing issues. So it's extraordinary to see a 9-to-1 ratio in advancing issues on the NYSE. So being that this was only a 1-month-long divergence in the OCO advanced decline line, even if this was, let's just say, the start of a new bear market, the chances are it's probably not such a bad bear market, just given the short length of that divergence. There's a lot of damage that's been done that's reset the market so that we can make another push to the upside. We see the current market environment as a great long-term buying opportunity.
You all know the term group think. Well, I call it group stink on Wall Street. I call them possible improbables. Use a portion of your portfolio in these outlier events, and the returns can be great and deliver extraordinary alpha. I've been doing it for a long time. My guesses usually average around 55%. Some of them are crazy. The first surprise is that the U.S. enters a recession in the third quarter of this year, followed by a lengthy period of stagflation. Second one is the Federal Reserve pauses and then cuts as currencies and interest rates swing wildly this year. Surprise number 5 is peak Trump. The president bows out in his pursuit of a second term. Surprise number 7 is a new but old shining object appears as a stock market winner in 2019, that is gold. Number 8, surprise, private equity, high yield debt, and leverage loan problems, which have doubled in size over the last 10 years, emerge as the resurgence of leverage finance comes to an end. Number 9, surprise, the Chinese-U.S. rift intensifies as Trump's anger shifts towards that region.
We are using kind of duration or interest rate sensitivity as a way to play defense in a portfolio that still likes equities. So it doesn't like equities as much as it did in the beginning of 2018. But we've right-sized that risk. Equities are still a high-confidence trade, especially in the U.S., and we are not afraid of rising rates. We're using duration as a way to play defense in the portfolio. So this economy right now is like riding a Vespa. It's not as exciting as the Corvettes of the 90s, when trend growth was at 5 or 6%, when inflation was really a problem. So that 5% is somewhat arbitrary to me because trend growth is so much lower than what it was in the 90s. So in other words, it doesn't take as much stimulus or Fed funds rate to drop in order to provide stimulus to a economy that's not growing that quickly.
There's so much artificiality in the economy. We need more and more debt to produce a Vesper-like expansion in economic growth. With a Fed funds rate in the United States at 2.5%, why is growth running Vesper-like? Why is growth so fragile? So I contend that there is material downside risk. We don't have the monetary capability with a Fed funds rate at 2.5% to do much stimulus. So I see a fragile economy. I don't see the monetary tools to stimulate. I don't see the fiscal tools to stimulate. And I think we're up Schitt's Creek.
I would say that this 2%-ish growth is not a tragedy. It's not what it was in the second and third quarter, but we are not forecasting recession in 2019. But late cycle means that equities are more volatile, so it probably means a 10% position in equities last year when volatility was lower has to be lower now, and cash becomes part of the portfolio now. I mean, cash was like the worst four-letter word besides fees you can put in a client's portfolio for most of this cycle because it had a zero interest rate, right? So if you can get cash at 2.5%, that's above inflation, that probably means it belongs in a portfolio.
Any thoughts on where we're at with interest rates, the 10-year, the 2-year?
The Fed took their balance sheet from about $1 trillion to $4.5 trillion through QE, and they want to get it back to about $3 trillion. The size of their balance sheet did something to the back end of the curve. Something. I don't know what it is. I know it's greater than 1 basis point, though, right? So why am I bringing that up? Because 2s, 10s is really flat. The difference between the 10-year Treasury and the 2-year Treasury is very, very flat. 2s, 10s always flattens in a tightening cycle because the 2-year part of the curve, it's very easy. If the federal funds rate is going up, the 2-year part of the curve goes up. The back end is driven by 2 very important factors: inflation and demand, specifically foreign demand. So I think 2s, 10s is this flat this time, A, because inflation is contained. And the second thing is German Bund being at 25 basis points and the Japanese government bond, as Dennis brought up, being close to zero. But most importantly, I think quantitative easing did something dramatic to the back end of the curve. And it's, you know, as easing goes, it's down in an elevator and up in an escalator. Because some people think that one of the mandates for the Federal Reserve is to keep equity investors happy, and it's not. They're not traders. And it doesn't matter who the president is or what his or her trade policies are. If the dollar's strengthening, that's a bad sign for EM. So if you can get the dollar to behave in 2019, that's going to be a pretty nice tailwind for emerging markets this year. And part of that has to do with, again, going back to Jay Powell and the pause in the tightening cycle.
Annual interest on a debt basically serves as a governor against growth. And the Vesper will run out of gas at some point. With the 10-year at 2.85% and the debt at $22 trillion, we're not concerned because it's producing annual debt expense of $480 billion a year. But if you get a spike in rates, which will ultimately have a normalization of rates for whatever reason, inflation probably, I mean, the problem is profound. I think that China thinks in terms of decades and centuries, and the president thinks in time frames of tweets. And the notion, like my partner Jim Cramer, I believe erroneously thinks China's decelerating growth and high debt loads will create a more favorable negotiating backdrop. I disagree completely with that. I don't think they care what happens in the next few quarters or years. Beginning in late January of 2018, we entered a new regime of volatility. There are a bunch of reasons for that. There's political turmoil, there's China, there's a lot of things going on. Monetary policy, there's untenable levels of debt. You have to, in this new regime of volatility, reduce your VAR, reduce your value at risk. Phil, I think what you said is that cash has value now.
And what that also does when cash is a viable asset class, I mean, how many times did we have, like post-Brexit or when we were in, you know, zero interest rate policy, how many times did we have the V-shape where equities went down really hard and then they went up almost just as fast? When you have cash as a viable asset class, when equities go down, there's not these buyers that are just coming in because cash is so expensive and it's so expensive to be out of the market. So that prevents kind of the real whip up in the asset class.
You know, we do believe that we're coming out of a major intermediate term low here, and we have seen a correction, and we're not at the start of a major big bad bear. So take advantage of it where you can with high quality stocks.
I would say the biggest thing for 2019 goes back to what I was saying earlier about the Fed. If they're off the table for the first 6 months of the year, that's new information that we think is going to let the dollar behave. And hopefully, and it's been subtle and it's been kind of, not very widely talked about, but something like emerging markets in that world, absent a trade war, that's our biggest downside risk. Okay, is that if we get past March 1st and there is nothing that gets done, and the $250 billion tariff doesn't stay at 10%, it goes to 25%, that would also be new information. But I think a balanced portfolio this year, a portfolio that includes fixed income for ballast, and also a portfolio that includes both U.S. and can take advantage of upside in the emerging world. And remember, I said emerging world, not necessarily Europe. I think some of those things make some sense this year. And, you know, we quoted Mark Twain already. You know, Mark Twain also said, it's not what you don't know that gets you into trouble. It's what you know that's absolutely for sure that just ain't true, right? So investing is very emotional. A lot of people knew a lot of things coming into last year, and the only thing that outperformed inflation was cash.